Hello there and welcome to Vital Cash. In this video, we present a unique chance, possibly a once-in-a-lifetime opportunity, to amass wealth. The current landscape offers a remarkably favorable environment for a substantial increase in net worth, provided you navigate it wisely. As the saying goes, riches are made in recessions, and it's evident that we are heading in that direction. Despite the initial negative connotation, recessions are recurring events, and when approached strategically, they can pave the way for a secure financial future through incredible opportunities and discounts. Even investment guru Warren Buffett acknowledges that bad news can be an investor's best friend. Now let's delve into the specific expectations for the next 12 to 24 months and explore the optimal benefits available for seizing today. But before we discuss these promising opportunities, it's crucial to comprehend the challenges ahead. Recession, a term often associated with a surge in unemployment, declining wages, diminished consumer confidence, and across-the-board devaluation encompassing stocks, food, energy, and services, often with enduring global repercussions. Additionally, recessions coincide with a dip in earnings. Companies routinely disclose their revenue and future outlook, but recent trends indicate a cautious approach with reduced forecasts, anticipating sluggish or negative growth. This leads to the third challenge: layoffs. When consumer spending dwindles due to reduced income, companies, faced with diminished demand, trim expenses, often beginning with workforce reductions. A cursory Google search for mass layoffs reveals numerous companies adjusting their workforce, and according to Bank of America, the U.S. economy is poised to lose 175,000 jobs per month. Now let's explore what these circumstances mean for your investments. Number 1. Stocks. Currently, major indexes are down by 20 to 30%. Analysts like J.P. Morgan predict another 20% decline. Examining history since 1946, the average bear market drop is around 30%, with the severe 2009 decline of 57% from the S&P 500 peak. Combining this with the impact of recessions, bear markets tend to fare even worse, with an average drop of 34.8%. Typically, the absolute bottom occurs during investor capitulation, signaling the start of recovery. Number 2. Real estate. While variations exist across regions, national housing declines exceeding 10% are historically rare. However, the consensus on Wall Street suggests a potential 7% decline in national housing prices, with a worst-case scenario of 10 to 15%. Contingent on interest rate increases, it's important to note that market dynamics will differ. In conclusion, this period offers a unique chance to thrive if approached strategically. Stay tuned, as in the next few minutes, we'll delve into the potential gains from these opportunities. Every market possesses its own unique characteristics, and according to insights from Moody's Analytics, there's anticipation that the most susceptible markets might experience a significant downturn, possibly exceeding the 25% decline from their peak. This impact could be felt in regions like Florida, Arizona, Idaho, and Southern California. The projected decline is expected to persist for the next 12 to 18 months before reaching a stabilization point. Now, while this may not drastically affect individuals with fixed-rate mortgages planning to stay in their properties for the next 5 to 10 years, it introduces intriguing prospects for those looking to invest or purchase a house. As we delve into the details shortly, we must also touch upon the evolving perception of cash. Traditionally viewed as vulnerable to inflation, cash is now emerging as a refuge in times of economic turbulence. Even renowned figures like billionaire Ray Dalio acknowledge that cash is no longer to be dismissed as trash. It's worth noting that as recently as 2018, cash was the top-performing asset. Those who opted to save in high-yield savings accounts outpaced the market significantly. Cash is now becoming a pivotal element in portfolios, with fund managers holding the highest levels of cash since 2001, according to recent reports from Citigroup. Now, addressing the question of what actions can be taken to capitalize on the upcoming shifts and why many overlook these opportunities, let's break it down. Consider this. The next recession could be a unique chance of a generation. Firstly, a downturn leads to a decrease in overall expenses. While some may perceive this as an inopportune time to invest, astute investors see it as an ideal moment to acquire assets at a substantial discount, akin to Warren Buffett's analogy about hamburger prices. Secondly, reduced competition becomes a key factor. In challenging times, larger companies often retract, creating space for smaller, more agile entities to rise. Studies have shown that companies maintaining advertising efforts during tough periods experience increased value and long-term growth. Thirdly, a recession unveils a plethora of opportunities. It acts as the market's mechanism for separating the robust from the weak. Comparable to a forest cycle, where established trees dominate resources during peak cycles, economic downturns clear out less resilient businesses, paving the way for newer, smaller ventures to flourish. Lastly, it's crucial to recognize that after every bear market, there emerges a bull market, marking a cyclical pattern of economic resurgence. So in essence, the impending changes could present not only challenges, but also unique prospects for those prepared to navigate them wisely. As noted by Yahoo Finance, delving into historical data reveals that, on average, the S&P 500 experiences a 29% dip during a recession, with a median decline of 24%. However, once stocks hit their low point, the subsequent year sees an average return of 40%, and within 2 years, the market tends to rebound by an average of 58%. This underscores the profitability of investing during a downturn compared to withdrawing and waiting. The catch, however, is timing. Acting before the broader public catches wind of a recession is key. Predicting recessions is a tricky business. Consider the Great Recession, which began in December 2007 but was officially announced a year later, just months before it ended. This pattern repeats, with a delay of about 6 to 12 months before a confirmed recession is recognized. So what can you do to profit from these dynamics? Trim your expenses. Tracking the market, cutting unnecessary spending, and operating lean are crucial. Reinvest as much as possible back into the market, while having a plan in place to navigate a potential 20 to 50% drop in income. Hold on to some cash. While investing early is statistically favorable, having cash on the sidelines provides peace of mind and a financial fallback. For some, maintaining 15 to 20% of their portfolio in cash has proven beneficial, seizing opportunities and ensuring a good night's sleep. Safeguard your career. Your ultimate financial hedge is not just market resilience, but also job security. The worst-case scenario is a market downturn coupled with job loss, forcing premature sale of investments. Now is the time to upskill, learn new competencies, and fortify your professional standing. Embrace a long-term investment strategy. Continue business as usual, employing dollar-cost averaging, consistently buying into the markets. This tried-and-true strategy has demonstrated profitability over time. Diversify your investments. If a 20% drop induces panic, it's a signal that your portfolio might be too aggressively invested. Consider broadening your investments to include large caps, international stocks, real estate, or rent rights for stability. A diversified portfolio with multiple pillars is less likely to collapse if one or two components face challenges. In conclusion, now is an opportune time to double down on your efforts, perhaps taking on a side hustle and acquiring knowledge. The rewards for persevering through these challenging times will undoubtedly manifest as the market recovers. It won't be easy, but the payoff will be worth it. I hope this video has provided you with useful information and interesting perspectives on the world of investments during turbulent economic periods. Thank you for watching. Don't forget to subscribe, comment, and share. See you in the next video on VitalCash.